Hello and welcome to our finance mini-series. I'm Dr. Robert Clark and today's video is on debt financing. Now, as you will have seen from previous videos on the capital structure or the cost of capital, debt financing is a common way for companies to raise capital for their operations, their investments, or their expansion plans. In today's video, we will explore the different types of debt financing that exist and how a company might use these, and also how these different types of financing differ from one another. Let's start with bond financing. Now, bond financing or bond issuance is a very popular way for companies to raise large sums of money. Bonds are essentially loans that a company takes out from investors, and they come in various forms. For example, some of the characteristics may be that the bond pays a fixed rate of interest, as in the rate of interest is set prior to issuance, and then into the future, that rate of interest is paid. Another form of bond financing is a floating rate bond, in which a spread is paid above a reference rate. So in other words, when that reference rate changes over time, so do the coupon payments on the bond from the company. Now, there is different forms of riskiness within a specific company for these bonds. For example, there's senior debt and subordinated debt. Senior debt is less risky as it's paid first in the event of liquidation, and because it's less risky, it is a cheaper form of debt for the company because the investors are not compensated for a higher risk. Whereas subordinated debt or junior debt attracts a higher rate of interest to reflect its position in bankruptcy and its higher risk profile. In a previous video on capital structure, we touched upon securities that are a combination of debt and equity, including hybrids in Australia or preferential shares in other parts of the world. Now, mezzanine debt is another form of debt financing that fits into this category. It's a hybrid debt instrument that fills the financing gap between debt and equity. It's generally considered one of the riskiest forms of debt because mezzanine debt is junior or subordinated to the other debts while being senior to pure equity. Now that we've discussed bond financing and mezzanine financing, it's time to turn towards another traditional form of debt financing, being bank loans. Now, there's generally two types of bank loans that a company can use, being secured or unsecured. Secured loans require the buyer to put up collateral, such as property or plant and equipment, as a form of security in case the loan is not repaid. Unsecured loans, on the other hand, do not require collateral, but as such, they attract a higher rate of interest to compensate for the additional risk. Another form of innovative financing is invoice financing. Now, this is another form of debt financing that allows a company to borrow against their outstanding invoices. This type of financing can be useful for companies that have slow paying customers, as it allows them to access the cash that is tied up in those invoices and access that cash in order to operate their businesses while they wait for the invoices to be paid. The interest rates on these types of debt financing can vary significantly depending on the risk profile of the borrower, the type of debt, and the length of the loan. Generally, the more riskier the investment, the higher the interest rate. The seniority of the debt within the debt pyramid also plays a role in determining the interest rate. As we mentioned earlier, senior debt typically has a lower interest rate than unsubordinated or unsecured debt because it has a higher priority, a higher percentage chance of repayment in the event of liquidation. You can see there are many different types of debt. There are many different options available to companies. These companies will make decisions based upon what they think is best at the time. Each type of debt has its own unique characteristics, its own unique interest rates, and its own unique risk profile. One thing I would encourage you to do is simply put yourself in the position of the lender. If the debt is secured against something solid and there is no one else that needs to be paid before you, then obviously you can accept a lower interest rate on your funds. However, if it's a more risky form of debt, say a property developer who's tapping mezzanine financing, understandably, you would wish to receive a higher interest rate to compensate yourself for risking your money. Now, that's a good technique for understanding the differences in interest rates. Put yourself in the lender's shoes. I trust that today's brief introduction to debt financing has been beneficial to you. Obviously, we are just skimming the surface. This is a really deep topic, and it's one that we delve into within our various courses. So thank you for being with me. Please subscribe and please look out for future videos.